Hello and good afternoon, ladies and gentlemen, and welcome to the Two-Way Spreads webinar this afternoon. It's nice to see so many familiar faces and some new faces here today. My name's Gurpal. My colleague Zain will be hosting this afternoon session, and really the purpose of this session today is basically we're going to be covering hopefully more of an educational theme, as we always try to bring you from Two-Way Markets. We'll be looking at things like moving averages. If you just bear with me one second, we've got a lot more people coming in here. Yep, we've got lots of questions that are coming in here as well. What I'd suggest is regarding questions, I mean, I can certainly try to answer questions as we go along, but I think maybe for the flow of the presentation, it will be wise to maybe wait till the end of the session, and we'll certainly have a sort of a question and answer session later. So today, as I said, we'll be mentioning, we'll be using moving averages, looking at maybe some of the current charts that are out there, some of the markets. My colleague Zain will be looking at the online trading platform that we're currently offering at the minute as well. So let's get into it. Right, a bit about ourselves first of all. So Two-Way Markets, we've been established since 2003. We're fully authorized and regulated by the FCA. And what we basically do here is we try to bring not just an educational profile, but more of a sort of a brokerage bespoke type of service. So obviously, we've all got different individual needs and wants and requirements when it comes to our trading. We try to provide, ease of use when it comes to platforms, or whether it's use of execution service, obviously tight spreads, and obviously where sometimes the brokers don't have the time to speak to clients, we certainly try to give a more of a friendly customer service approach. And obviously, education and research. The research side of things is interesting because we'll be supplying some weekly or daily research in terms of markets very, very soon. And basically, education, obviously, with these webinars that we do, we've been doing them, well, since the end of last year, really, so they've been going very well. And yeah, really, hopefully that's something that will really add to your sort of requirements here. Right, so moving averages. Moving averages is a subject that we sort of covered, I'd say, back end of last December. So it's been a while, but we've had lots of questions asked about it, and obviously we've got a lot more new traders come on board. I'm not going to go into too much of the complexities of what new moving averages are, but I'm going to certainly try to keep it basic, and I'm going to apply some of the maybe averages to the current markets as we go along, and hopefully you'll find it informative. So, right, moving averages. So moving averages, what are they really? They smooth out price data to form a trend. They're basically a trend following an indicator. They do not predict price direction, but they rather define the current direction with a lag. So moving averages lag because they are based on past prices. So despite this lag, moving averages help smooth price action and filter out market noise, such as things like non-farm payrolls, market releases, news events. They also form the building blocks for many other technical indicators and overlays, such as Bollinger Bands, MACDs, and stochastics, which we've looked at in the past. So today we'll look at generally, what moving averages are, and some of the most commonly used moving averages, 20, 30, 50, and these are just some of the facts you may well know already, but some of you guys who are fairly new to what new moving averages are, just have a quick read of what some of these, the general sort of part of what moving averages really is factually. So, right. So there's two different types of moving averages. We've got the simple moving average and the exponential moving average. What I'll do is, I'll start calling them SMA and EMA, else I'll get tongue twisted all afternoon. So it'll prove a lot easier. So these moving averages can be used to identify the direction of the trend and define potential support and resistance areas. So the simple moving average, a lot of people ask me, SMA, EMA, what are the differences, which one shall I use, what's good for me, and I'll try to go through what they are and basically what it's all about. So a simple moving average is formed by computing the average price of a security or a currency or whatever over a specific number of periods. So most moving averages are based on closing prices. So a 5 simple day moving average is a 5-day sum of closing prices divided by 5. Might be a bit complex for that, but have a look at the little sort of infographic of what it's all about. So its name implies a moving average is an average that moves. So old data is dropped down as new data becomes available. This causes the average to move along the time scale. So if you have a look at this infographic that I've got below here, this is an example of a 5-day moving average evolving over 3 days. So the first day of the moving average simply covers the last 5 days here. The second day of the moving average drops to the first data point and adds new data point 16. And the third day of the moving average continues by dropping the first data point 12 and added by the new one, which is 17. In this example, prices gradually increase from 11 all the way up to 17 over a total of 7 days. Notice that moving average also rises from 13 all the way up to 15. So this is the moving average. This is the 5-day moving average, but this is the actual weighting of that moving average over 3-day calculation period. So also notice each moving average value is just below the last price. For example, the moving average for day 1 equals 13 and the last price is 15. So prices the prior 4 days were lower, and this causes the moving average to lag. Okay, so that is the SMA. So it's calculated by taking the arithmetic mean of the given set of values. Hopefully that's fairly sort of straightforward. I mean, I think it's important to look at what the formula is. I know the maths part of it does put a lot of people off, but it's important to understand what the algorithmic and the mathematics behind these are. And hopefully this is the simplest form I can sort of put that across to you guys. So we've got the EMA, the exponential moving average. So the exponential moving average reduces the lag. They both got lags, but the EMA reduces lag by implying more weight to recent prices. So the weighted applying to the most recent price depends on the number of periods of moving average. These are 3 steps of calculating an EMA. First, calculate the simple moving average. An EMA average has to start somewhere, so the simple moving average is used as a previous period's EMA in the first calculation. Second, calculate the weighting multiplier. Third, calculate the exponential moving average, and the formula below, if you look at it, is a 10-day EMA. So, so recent data is more important than what's gone on before, and a lot of sort of traders nowadays see this as a bit of a downfall of the SMA, of the simple moving average, because obviously as news comes in, as price action moves, the EMA is going to take into account of new weighted averages that are coming in, whereas the simple moving average will take more of a mean stance to what it's all about. And you'll see what I mean when I show you what graphs and how they compare to each other. Right, so enough of the maths. Let's move on to what they mean. So even though there are clear differences, as you can see from the formulas, the difference between simple moving averages and exponential moving averages, one is not necessarily better than the other, I would personally say. So EMAs have less lag, as we've distinguished, and therefore more sensitive to recent prices. And recent prices changes. So EMA averages will turn before simple moving averages. That's the simple crux of it. So SMAs, on the other hand, represent a true average of prices for the entire time period, such as simple moving averages may be suited better to when you're looking at support and resistance levels. If you have a look at this quickly, you can see how these are both 50 moving averages. The green one is, for those who are colorblind, the green one's at the bottom here, and the top one is the red one, which is the SMA. As you can see, the EMA is actually hugging the price action a lot quicker and reacting to the price action a lot quicker than the green one. The reason, as I mentioned, it actually reacts to new price data a lot more than the SMA, and the SMA is a lot more smooth, as you can see. So moving average preference depends on objectives, really. Analytical style, time horizon, and a lot of you chartists may like to experiment with both types of moving averages as well as different time frames to see which one fits the best. And if you have a look at this IBM chart that I've just shown you here, the 50 SMA in red, and the red one both peak late in January here. There's a peak on both of them, but the decline in the EMA is a lot sharper than the decline in the SMA. So look how the EMA moves down a lot more sharper with the price action than the SMA, and it's turned up a lot quicker as the price actions are more mid sort of February time, if you have a look at that. But the SMA continued lower until the end of March, if you look at that, while the EMA started to crawl up. So hopefully that sort of graphically shows you how the two moving averages sort of look on the chart. So obviously we've got different sorts of moving averages here and the different time lengths and what each of them really mean. Let's have a look at so basically something time frames and lengths and what the lag means. Basically, if you have a look at, people ask all the time, what is the best moving average to use? Some of the we get some real strange ones that people use, but the reason why people use them is because it actually works for them. Some of the main ones here, 20 days, 30 days, 50, 100 and 200. So a 20-day moving average, if you were to apply that to a chart, would be a very choppy line. It's not the most accurate, but it's probably the most useful in terms of for short-term traders. 30, again, it provides a bit more certainty, but again, it is fairly choppy. 50-day moving average, which is one that a lot of traders use, day traders and sort of more end-of-day long-term traders, provides a lot more volatile, a lot more smoother line, and it can sort of somewhat detect longer-term trends to medium-term. 100-day, very similar to the 50-day, again less volatile, but it is one of the most widely used moving averages. The 200, which I know not many people use, the 200 one for me is a very, very important one, a very key one, and I'd like to introduce you to the 200 one. A lot of sort of retail clients, retail traders don't use it. A lot of fund managers, asset managers, and people actually in the market do use a 200 moving average. A lot of analysts out there, even it's a very even less volatile than all of them, as you can imagine. It's more of a rolling chart, a smooth line, and it doesn't react to quick movements. But one thing about the 200 moving average is from what I've been taught in the past, it actually acts as a guideline to the bull and the bear market, as a line in the sand. So if you find price action above the 200 moving average, you can safely say we're in a bull market. Below the 200 moving average is a key cross. People say it's very much entering into a bear market. Start using the 200-day moving average, not necessarily for 15 or 5-minute or smaller time frames, but for daily, weekly, 4-hour, hourly charts. You'll get a lot about it. I mean, it's important that you're sort of you're using some may be popular than others, but as I said, the 200 is a very important one because of its length. It's clearly long term, but the next 50-day moving average is important to what you're trying to show people. So that's the length and time frames, and obviously as we've mentioned with these time frames and what moving averages are. There is a lag factor. The longer the moving average, as we mentioned, the more lag these prices will have. And just to show you here, obviously the 10-day moving average will move a lot quicker than say a 100-day moving average. So this is the price action, as you can see with the bars. The 10-day moving average is basically hugging every sort of dip and trough that and peak that this price action in the S&P 500 is making. The 50-day moving average a lot less. As you can see, it's a lot more smoother, and the 100, again, even more smoother than that. It's a 200 periods of MA, Roman. Roman's just asked me about the 200. A 200, is it better EMA or SMA? Keith just asked me. Personally, I use the EMA because it's a lot more dynamic. Hey, but I'm not there to say that the SMA is any worse off. Keith, you should be able to see the chart there. I don't know why you can't see the chart, but the chart is there below there. Can you see that now? Okay, good. We can see that now. Great. Right, so basically what I'm going to show you now is how traders use moving averages. Here's a simple moving average here, and how you can define and how trends use it. So if you notice the price action here on this chart, notice how the upward trend here on the price action is actually hugging the 50 moving average. So every time the price action comes below the 50 moving average, we start pointing up, we start going up. These are entry points, and this is when we say trading with the trend and using the 50 moving average along with other indicators to actually determine when to get in. So every time the price action comes down to the 50, we spike up. And likewise here, when the price action eventually dips below the 50 moving average, the price starts to crawl up to the 50 and it fails. Again, down we go. Again, we start to go up, down, again it goes. Selling opportunities, buying opportunities. Hopefully this sort of fairly clearly, simply illustrates just how traders use just a simple moving, a normal moving average, a 50 moving average when it comes to a trending market. Again, support, and this is a 200 moving average we've got here, and you notice how the 200 moving average here is act as a strong level of support, and you'll see a lot of support when it comes to 200 moving average. When you hear a lot of technical analysis say that the 200 moving average has been broken, it's a fairly key event when it comes to market analysts, because as you'll see, I'll show you a couple of the graphs, a couple of the charts, shall I say, after the educational side of it, how current markets, especially some of the indexes, how they've been behaving here. But the 200 moving average, again, if we were looking to buy it could be anything. It could be the Dow Jones or the Eurodollar. If we were looking to buy a particular instrument here, we will potentially be looking to put a trade or an order just above the 200 moving average. And what we would do is we'd put potentially stop losses below the 200 moving average. So when it comes to trading, a lot of the professionals use this as a fantastic strategy. So orders will always be slightly on or above the 200 moving average, and stop losses will be below, because if the 200 moving average does get breached, you can safely say that the market's certainly cracked going downwards. Just on this particular example. Again, it works very much like resistance. So as the market has dipped below, it's going to attempt to start going back up again. And for every attempt it starts going up, the 200 moving average will play a key factor here. So again, if I wanted to sell this market, why would I be trying to sell it and try to guess here? If I want to sell a market, I'd start putting orders as the price starts getting closer to the 200 moving average, and as it gets closer, I'll be putting sell orders all along here with my stop losses just above here. You know, it's a safe trade, and it's a trade you can actually rely on. And when you're trading a sort of long term or end of day, it certainly works very, very well. I can see a lot more people that have joined us since we've been going. For those of you who have just attended this webinar, just to let you know, I mean, some of you will probably come in afterwards. A recording of this will be sent out to each and every one of you, just to let you know. But if we carry on, here's a crossover here. If you notice how the 20 moving average provides support for the first stock on its way up, and here we go. Now there's a price action. We've come back down. We can't break it. We've moved back up again. 1, 2, 3, 4 times there, and you know, any time it's gone, we've repelled it. These are lovely buying opportunities. Again, once we've crossed over, the price is going to struggle to go above, but anywhere it goes anywhere near above it, you know, you can safely put selling orders down there. And we know it's the beginning of a downtrend. And here again, we've got a crossover here. Notice how the short-term average crossed above the long-term average. So here we've got two moving averages. We've got the 50 and the 15. So once the 15 moving average here has crossed over, this is the beginning of an uptrend in this particular chart. And as soon as it's crossed over, it's a bullish sign that we can start buying. You can start buying here. Yeah, Keith, you may find a bit of lagging in the charts. That may be because of your internet, because of your server, but hopefully most of you can see the charts fairly clearly in front of you. But just getting back to it, as I said, the moment we cross over the 50 to the 15, we're entering a sort of a bullish phase, and all this means is basically anytime the market, we have a pullback to the 15 or anywhere close, we can safely buy. So the moving averages are lagging, but what they'll give us indicators. They'll give us a clearer picture of when we should be buying and selling in these markets. You know, when we're on the right side, rather than having to. Ben, good question. Well, how to determine the best combination? You know what? It really does depend on what market you're using. And sometimes, as you know, different markets are trading very differently. So, for example, if we're trading a euro sterling, it moves very small amounts. Then, if you're trading something like a sterling yen, which can move 300 points in a day, you know, it depends. It's a case of really. It's not me here to say, oh, I think you should be using the 15 and the 50. It doesn't really answer the question. It really is a case of putting the chart up that you like to use, or the market, and then applying the moving average. Go for an hour or a 4-hour moving average, Ben, and then start putting the 10, the 15, or the 50, or the 10, and have a look previously how the chart has reacted to those moving averages. And if you can see a pattern emerging, you know, you don't need to be a rocket scientist to see when I've traded gold, and when the price comes back to, say, the 20 moving average, it always retracts. Then you know you can actually, you've got the 20 moving average working well for you. All I'd say to you guys is always put the 200 moving average, and from that start working downwards. The 20, the 50 and the 200 are key, and around that, if you're day trading, if you like to scalp the market or you like to day trade, start experimenting with 13, 15 moving averages, and you know, you'll see a pattern emerging whereby price action is retracting against certain moving averages and crossovers, and you'll know from that. If moving averages is one of these subjects where a lot of it does determine self-education by trial and error. You're looking at it and you'll know, yep, that will get me in the trade better than if I use a 20 moving average. So have a play about with it, and the charts that my colleague Zane's going to show certainly will show you that. And just before I finish off here, just want to show off a few more situations here. I showed you earlier here, here's a 200 moving average, and if I wanted to say buy the 200 moving average here, I'd put a stop order just below the moving average. You know, there's a reason why I would put a stop loss here, because again, if I wanted to buy, that's fine, but if it ever breaks, I'll be stopped out the market, because if I didn't put a stop loss below there, I could be losing a lot of money going downwards. So, you know, think about, use moving averages when you're putting stop losses. You know, don't put them above a moving average. Always put them, especially if you're buying, put the stop loss below the moving average. If you're selling, put your stop loss just above the moving average. Hopefully that's nice and simple. It's a simple way for me to put across to you that, you know, there's a reason for you to put that stop loss there, because if that moving average has been broken, there's a reason why it's been broken, and, you know, you want to get out that trade ASAP. So let's conclude on some of these factors about moving averages here. I'm going to quickly, it was a nice bear flag there actually, Ben, but, you know, the advantages of using moving averages, the advantages, should I say, of using moving averages need to be weighed against the disadvantages. So moving averages are trend following, as we've seen, and they're lagging, as we've also seen, indicators that will always be a step behind. Yeah, so, you know, they're not going. Moving averages are not going to be a crystal ball. They're not going to tell you where the market's all of a sudden going. Yeah, this is not necessarily a bad thing. After all, you know, the trend is your friend, as you've heard that before many a time, I'm sure. But it's best to trade in the direction of a trend. And I've been involved in trading. I've been on the trading desk for nearly 13 years. And, you know, for most of you guys here, I've seen so many people waste away their accounts and their trading. And I can tell you the simple, biggest reason why people destroy their trading accounts. And this is from my 13 years of experience of being on the market making desk of various companies, is people try to be heroes out there. They try to pick tops and bottoms of markets. You know, we're not in this game to pick tops and bottoms. You know, this is not what trading is about. It is about trading with the trend, but it's about trading, you know, the safest way possible. And using moving averages along with other indicators will give you a bit of a head start and to make sure that you're not picking tops and bottoms. You know, it's certainly not the way to do it. Moving averages ensure that you as a trader are in line with the current trend, even though the trend is your friend. You know, that you'll spend a great deal of time messing around with different ranges and whatever, and the one that will fit you, the way you trade, you'll get there. You know, whether you're trading the Dow Jones or the Eurodollar or gold, you'll know by using different moving averages, this one fits me perfectly, because I'm a day trader. I like to look at the 15-minute and the hourly chart, have a play about with it, and the one that suits you well, you know, it will certainly keep you, you know, up there. So don't expect to sell at the top and the bottom using moving averages. It doesn't work like that. It works by giving you safe entry points and exit points. You know, hopefully that sort of helped you in terms of what moving averages are, how to use them, how to get the best of them. What I want to do now quickly, I know Zane, my colleague's waiting, is I want to sort of show you some charts here with moving averages. If I just let me just, best thing to do is bring our trading platform here. So some of these current charts that we're showing here, here's the FTSE here, for example. I've already added a moving average here. For those of you here, I'll let Zane show you how to add a moving average, but for those of you, just quickly, if you go to studies, you've got the, where is it gone? Simple moving average there, and you've got the exponential moving average here. It's simple as that. You can add those on. What I've got here is I've got the 200, 50, and the 100. And I wanted to show you this 4-hour FTSE chart. We've seen the FTSE in the last few days and how things have been developing in this index. And just look at this. This is the 200 moving average, yeah? And this is the 4-hour chart, mind you. Let's just quickly go to the daily chart. Here's the daily chart here. Wow, with some serious some serious moves here in the FTSE. If you look at here now, the FTSE, we crossed over back in October. The 100 and the 50 crossed over round about here. So we've moved over. I mean, we're not gonna catch this market. I mean, unless you're lucky, unless you want to try it, we're not going to catch it. We've moved up. We've now absolutely rocketed above here. It's the key area now here. If you look at it now, we've broken above the 50 moving average, and we're about to approach the 100 moving average here. Whether we go through that is going to be key, but look what we've got above here, the 200 moving average. You know, why can't I look to sell anywhere near the 100 and the 200? I would potentially look, if I wanted to sell the FTSE, I wouldn't be selling it anywhere here, but I'd look at here, what 66.15, you know, potentially I'd put my stop loss above here just to see whether we break the 100 moving average. You know what, it's a safe trade. You know, if I wanted to try to pick a top, again, the 200, 66.43 on the daily chart. You know, if I wanted to sell it, I'd put maybe an order just below there and a stop loss above there if I wanted to sell it. And this is me not telling you to go into a trade, but it's a way of you looking at moving averages and how you'd enter a position. Do you understand? Yeah? So if I move that down to the 4 hour, again, look at this. Let's make this even smaller here. So we've got the 400, we've got the 4 hour moving average. Again, we've had this big move down, and now we've had the 50 moving above the 100. Look at this crossover here, a very key crossover. We've got the 50 attempting to cross over the 200. You know what? Potentially we've got a very, very bullish move here, a very bullish move. So, you know what? Not saying this market's going to carry on going up, but if it does go up, it wants to potentially maybe pull back down to the 200 before it goes up. The 100 and the 50 needs to go above the 200 before we can say we're back above bullish territory. Yeah, so these are key elements for you to have a look at, you know, where we can actually say, you know what? Do I buy here? I could be buying at the top, really. If you look at it here, do I really want to buy here? You know what? Maybe not. Maybe I want to wait for this to be coming all the way back down, anywhere near the 200. And by then, if the price action starts coming below, down to the 200, and by then the 100 and the 50 might have already crossed over, there you've got a classic buying opportunity. See what I mean there? Hopefully that makes sense. That's the FTSE. Let me get out of there. I can see Zane nudging me in the background, so I won't be too long here. Again, here's gold, for those of you who love gold. Look at here. Here's the gold 1 hour chart. The 50 moving average. We came to the 50, we didn't like it. We rejected it. Look where we are. We've bombed back up again. We're up to the 50 again. You know what? We could potentially sell this market if we wanted to. And if we wanted to, we'd put the stop loss just above here. And we may have been stopped up, but you know what? Gold, if it wants to, it's got a lot of issues up here, above here. We've got the 100 and we've got the 200 moving average here. So you know what? We're not going to be selling down here. We're going to be selling when gold starts getting more interested in the moving average. This is if we move that to a 4 hour, you know what? Do we want to be selling that or buying that? No, because look how far the moving average is away from the price action. We can't trade it. There's nothing there. Azuka, you just showed me. This is the 4 hour moving average. Let's move that down. This is the 4 hour time frame. Here's the daily. Let's try and make that a bit more clearer. Here's the daily. Again, where are we? We're absolutely miles away from the moving average. Not until this price action gets anywhere near the 50 or the 100, we can't even be selling gold. I mean, of course, those of you who are trading more short term, you're going to see these opportunities on an hourly basis. You know, here's the hourly chart, sorry. You know, every time here you could potentially sell. Every time the price action gets in between the 50 and 100, you might want to look to sell it. Anywhere there, you want to look to sell it. Don't get confused by trading long-term and intraday. This is the single biggest problem that people have. They start looking long-term and decide whether you want to be an intraday trader or a long-term end-of-day trader. Don't get the two confused, because if you do, you will end up in a mess. So, you know, what I'm trying to portray here is, you know, short-term trading here, like our half an hour chart here. Here's a half an hour. You know, I'll probably look to sell that because here we go, look, we've hugged the 200, we've sold off. We've hugged the 50, we've sold off. Again, we've got to the 100, I may look to sell here for a few pips. Do you understand? This is short-term trading. But if I'm long-term trading the gold, am I interested in the gold? Not for a long time yet. I'm not going to be interested until we get anywhere near there. Hopefully that's very clear for me to sort of point out the way we're using moving averages for a long-term and a short-term trader. It's been about half an hour for me. I'm sure you're probably sick and tired of hearing my voice. I'm going to be passing you over to Zane here. He's going to be going through the ETX Trader Pro platform. We've got lots of questions. Hopefully we'll try to cover those towards the end of the session. But thank you very much from my point of view. And I'm going to pass you over to my colleague Zane. Thank you very much.
Cheers, good pal. Guess that final nudge did it then, eh? Can I just get a few confirmations about people who can hear my voice? So to make sure that you guys can hear me, and also I'm not just sitting here talking to a monitor. So just put yes in the chat box if you can hear me. Cheers, thanks Philip. Cheers, Sol. Nice one, excellent. All right, cool. All right, so I guess you guys can hear me. That's good. Okay, right, so as Gopal said, I'm just going to take you guys through just a nice short and sweet demonstration about the ETX platform. I know you guys got sort of weekend plans to get onto, so I'll make this nice and brief as well. Okay, Bill, I'll try and potentially could be an internet problem of some sort on your source side, but I'll try and make it something a bit more slow so you can see the charts for yourself there. Anyway, yeah, so just back to the platform. As Gurpo said at the beginning of the session, we here at 2A Markets are an introducing broker, and we do have sort of affiliations with a lot of other bigger brokers out there in which we can offer some very good competitive platforms for you. So you might be asking, well, why are we sort of focusing on the ETX platform itself? Well, a lot of clients that we do have, a lot of clients that we do sort of place in trading platforms seem to like the ETX platform that we give to clients, simply because of its fast execution, its features that it has, and also generally based on what you can do with the platform as well. I mean, you have very tight competitive spreads there. You'll have certain sort of features you can use, such as your charting systems you can apply onto your charts. You can amend sort of stops and limits onto your charts as well. I'll show you that too for fast trading. And also something a lot of brokers don't offer out there is that free same-day fast payment method. So, you know, ideally, some of you guys are trading today and you want to spend a bit of that money on the weekend, you can get that money out today as well. So it's just some of these nice features that you can get as well. So I'm just going to show you through the platform so everyone can see our little ETX Trader Pro here. Now, in terms of really making this as fast as possible and also just getting down to basing of what am I going to trade and which products am I going to trade, the best thing I think initially to do is to make sure you set up your own watch list. Now, you know, I know when you go to sort of these markets, you'll be seeing tens and tens of different products that will be flashing red and blue at you, and you'll be like, well, you know, I'm not going to be trading all of these. I initially want to be trading the things I want to trade and apply my certain moving averages, for example, on those products as well. So the best thing to do is to set up a watch list. So as you can see on the left-hand side of the platform, there's a tab or a title which says watch list here. All you have to do is click on the square next to it, which says manage watch lists. As soon as you click on that, you have the choice to add as many as you want. Now some of you, just to make it simple, you can add an indices watch list. You can add an FX watch list, just things of that nature, just to make sure that you've got those columns there for yourself. So when you click on them, it's just the sort of products you want to trade on. Now if you want to keep these there, just click on Save. And there you have it. As you saw on the left-hand side, 2 more certain watch lists drop down there for you. Now if we go onto sort of the indices page here, or I think it's the popular markets page here, if you click on the folder just next to the product you're trading, it says add to watch list. Just click on that button there. Now because it's an indices, I'm going to click on my indices watch list there. I'm going to do the same with the S&P. On the folder, add to watch list. Click on that indices as well. Now with these 3 Forex pairs, what I'm going to do is going to add them to the Forex watch list. Same process, add to watch list, but instead go on the Forex tab. I'm going to do these with the remaining 2 as well. Okay? Nice and simple, just like that. Now, if we want to go to these products and make sure we can trade them, just click on the tabs on the left where it says indices. So there you go, your S&P and your Dow, and also on your Forex, you've got your pound, pound Australian dollar, you got your cable, and you got your dollar yen as well. Okay, so that's a nice little thing to start up with. Just get those watch lists going. Another thing as well, guys, if you have softwares that you trade on, another thing you can do, which is very good, is you can actually open up a trade ticket window. Now, if you click on this button here, it says open as trade tickets. I'm going to click on there, and what you get is a nice little external window something you can drag out onto your own software that you do use, and you can use your one-click transactions onto there as well. So that's what I'm saying, fast, quick execution as well. Unfortunately, Roman, the red and blue lights are forever there on the platform, unfortunately. So I think it's something, I guess to get used to. I think, after sort of a couple of times you're on the platform, you just initially get used to it. So it's something that you can definitely adjust to too. But all in all, it shouldn't be that much of a problem. So there's sort of external window for your watch list there as a trade ticket, okay? And you can exit that just like that, as quickly as that. So, for example, as Gopal said, to move and to really get onto the charts and find out how you can apply these, I guess, trading studies on there, I'm going to go on the Dow. I'm just going to expand it here. Now, what you can do initially is you can click on this button here for studies, okay? So just click on that button there. What you get is you get a tab of all these sort of indicators that we've used in the past as well. I know some of you have been here for the ADX indicator, the MACD, moving averages as well we've done today. All you do is just click on one of these. So let's have a look at the EMA. You get certain parameters, so as Gopal said, sort of the time frames you can use as well. And again, use the styles and things of that nature too. The same can be applied for the SMA too. So if you want to make it easy for yourself, you can choose a variety of colors. You can also highlight it with width, and also the descent color will give you just sort of those features which make it easy for you to have a look at the crossovers between the SMA and the EMA once you do apply it onto your charts. So let's just, for instance, add this on. So we're going to copy that. Yep, that's fine. So that sort of EMA is there for you. Now, a lot of traders, what they do is when they come back onto their platforms and they do like using these indicators, they want to save it on their charts. Okay, it's very important because, again, with sort of fast trading, when the market's very volatile, like recently we've seen, we want to be able to go straight onto the platform and use those indicators straight away. So if we just click onto settings and we save chart settings, now this automatically saves your chart and has the trading indicator there for for as long as you don't change it. So if you log on to the platform again, that moving average will be there for you. Or if you'd like to add other indicators on, such as your ADX or maybe your Bollinger Bands, then all you do is you save a chart template. So you can have many chart templates. One could be for your moving averages, one could be for your Bollinger Bands. Hey, one could be even sort of a mixture of the two. Okay, so as long as we sort of use these chart settings, we can actually go and create different templates for our different indicators. As you can see there, we sort of went from moving average template and also to an ADX average template as well. So again, utilize this as much as you can to really emphasize which trading indicators is best for yourself too. You don't want to be crowding too many indicators into your charts because they'll get too fuzzy, there'll be too much going on, and eventually you start having a headache about how many indicators you've got on your charts, okay? So really carefully choose which ones are best suited to yourself there. All right? Now, again, as I mentioned, with the fast execution, you can trade directly off the charts, okay? So you've got a sell button here, you've got a buy button there. You can also, on the ETX trading platform, you can trade at 50 pence at a 1 point spread on the Dow, okay? That's within trading hours. Now, if we want to, let's just say, for instance, we want to sell. So let's just click on this sell button here. Now, if we go on to trading on this top tab here, I'm just going to put this down there, we can actually get our trade directly displayed onto our chart like so. Okay, so as you can see here, it tells you what level it goes at, it tells you about our P&L as well, and also how much we put into the specific trade. Now, we can do everything on the chart. For example, if I click on this I button here, I can bring up a limit and I can bring up a stop. Okay, I don't even have to enter the values in. I can just simply use it on my chart, just like that. Okay, same with the stop. I'll do exactly the same thing. All right, click on OK, and there you have it. I've already just put on a stop and a limit for my trades. It's that quick. I mean, you don't have to wait around for even putting numbers if you don't want to, even though you can do on this platform. But the fact that you can actually do it on the chart just makes it so much easier for yourself just to put these in, and away you go with your trading. You can also adjust these just like this. You can drag them down, and you can drag it up as well. Okay, it just shows you how fast you can be on this platform, which is essential for your trading. Okay, if you're done with the trade, all you do is go back to your specific trade and just press X on that button there. Okay, click on yes, and that's it. You're out the trade. That took me about 20 seconds or so, folks, just to go into trade, amend my stops and limits, and come out of the trade. It just shows you how quick you can be with this particular platform. Okay, that's one of the good features about this ETX platform too. All right. So again, we have a variety of different products you can trade. We have FX pairs from the major to the exotic. A lot of equities we can trade as well. You've got your UK, your US equities you can do as well, as long as sort of your futures that if some guys want to do as well too. All right. Now, with this ETX platform, what they do kind of do is they update their platform as quickly as they can, as frequently as they can as well. What you guys might have noticed recently is that when you click on a certain order button, what you can get is when you sort of go onto trade ticket, let's just go onto the normal one here, you can bring up a chart for when you actually want to go into the markets. You can change the time frame, let's go on a daily chart here, and you can actually have a look at that chart. And if you see any potential movements, if you see anything that's going to go, happen in terms of news events, something pops up and the chart starts acting in a way you may feel you can predict, then you can easily have a look at that sort of chart there and sell and buy, choose your quantity, and even put in your stops and your limits as well. Okay, it just allows you to really get into the market as soon as possible. Again, you can add in a level for your new orders. You can have a look at your product info for that particular product, so your margin requirements. You can have a look at certain charts for that as well. And also generally, as a pip calculator, want to find out how much you're looking to gain in terms of the markets based on your stop and your limits. You can also put in that as well. Okay, so it's a very nice and fast platform, something that we believe a lot of clients do quite like to use, and something as well that we can provide incentives towards. Now, a lot of times, brokers out there, they don't really have a lot of leeway to give yourself in terms of trading. However, here at 2A Markets, we want to make sure that clients can get an investment out of the markets and can use sort of offers and incentive schemes which they can provide for themselves in terms of trading, making sure that it's something feasible for them, something that they can actually reach, and something that helps them with their trading as well. So that's definitely something we can offer you too. Okay. So, yep, as I said again, at 2A Markets, we have those sort of spreads that you guys like, nice and competitive and tight, such as a 0.7 euro dollar. We've also got 0.9 on the dollar, yen, and the cable, and 1 point on your FTSE, Dow, and your DAX as well. One-click order transactions is very quick. No problem at all, so that's fine. I'm glad you enjoyed it. Please come along to some other ones as well we do. Again, yep, 50p per trade. You can always go down to 25 pence on the euro dollar and also 10 pence on gold. So it does give you that management and that flexibility as well in terms of your trading. A lot of these other brokers out there, you can trade sort of £1, £2 a point. It can be quite dear sometimes. It doesn't really give you the flexibility to really go into the market at that price you want to go into and start using these indicators that we've taught you as well. Using these moving averages, you don't want to be initially starting at £2 a point when you're just trying to find out if it's working for yourself. So the ability to sort of trade at a low stake per price, gives you that possibility to do so. Okay. Again, trading from charts, and also we like to provide as many of these webinars as possible for you guys. The whole point about really learning in the markets is also giving sort of clients that education to make sure they can do so on a regular basis. We try to do as much of these as we can, making sure you guys can do as much with it as possible. All right. So again, yep, there's the details for you. Gerpals and mine email addresses, also our number there too. We've got our Skype addies as well, so for people abroad, feel free to call us on our Skype if you want. And have a look at our website. We've got some definitely more features on there as well in terms of the spreads of our platforms, in terms of what other things we can offer you, and also those incentives that you guys like as well in terms of your trading. So have a look at that website, and any sort of questions or queries you have, guys, please give us a call, give us an email. We're here to help, and we want to give you as much education as possible. All right, so thank you for attending, guys. I hope you had a good session, and have a good weekend. I hope you enjoy it. I hope there's a bit more sunshine for everyone to go around. Yes, we do. So it's sort of an introduction sort of fee there for us that we do get. But please give us a call, so if you have any more questions, and we can potentially help you out with anything else you need in terms of the trading platform. Thank you, guys, and have a good weekend.